This LOS is describe the major types of securities, currencies, contracts, commodities, and real assets that trade in organized markets, including their distinguishing characteristics and major subtypes. Assets and contracts, securities. So we're going to start by looking at fixed income. Fixed income instruments contractually include predetermined payment schedules that usually include interest and principal payments. Fixed income instruments generally are promises to repay borrowed money, but may include other instruments with payment schedules, such as settlements of legal cases or prizes from lotteries. So that's a very important point. Most people think of fixed income as bonds, but look at that last sentence, that it may include other instruments, and it has settlements of legal cases and prizes from lotteries. I guarantee that most people wouldn't include that as fixed income on their first thought, okay? The payment amounts may be pre-specified, or they may vary according to a fixed formula that depends on the future values of an interest rate or a commodity price. So that would be some floating rates, okay? Bonds, notes, bills, certificates of deposit, commercial paper, repurchase agreements, loan agreements, and mortgages are examples of promises to repay money in the future. People, companies, and governments create fixed income instruments when they borrow money. Now we will look at equities. Equities represent ownership rights in companies. These include common and preferred shares. Common shareholders own residual rights to the assets of the company. What are residual rights? Assets minus liabilities equals equities. Sell all the assets, pay all the debts, and those are the residual rights. So just remember, assets minus liabilities equals equity. That's residual right. That's important. They have the right to receive any dividends declared by the boards of directors. And in the event of liquidation, any assets remaining after all other claims are paid. Acting through the board of directors that they elect, common shareholders usually can select the managers who run the company. Preferred shares are equities that have preferred rights relative to common shares to the cash flows and assets of the company. Preferred shareholders generally have the right to receive a specific dividend on a regular basis. If the preferred share is a cumulative preferred equity, the company must pay the preferred shareholders any previously omitted dividends before it can pay dividends to the common shareholders. So that's a cumulative preferred. Preferred shareholders also have higher claims to assets relative to common shareholders in the event of corporate liquidation. That's important to understand. For valuation purposes, financial analysts generally treat preferred stocks as fixed income securities when the issuers will clearly be able to pay their promised dividends in the foreseeable future. So that's a really key point. I maybe should have put that in bold, that for valuation purposes, financial analysts, and it says not always, but generally treat preferred stocks as fixed income when the issuers will clearly be able to pay. Now we'll look at pooled investments. Pooled investment vehicles are mutual funds, trusts, depositories, and hedge funds that issue securities that represent shared ownership in the assets that these entities hold. The securities created by mutual funds, trusts, depositories, and a hedge fund are respectively called shares, units, depository receipts, and limited partnership interests, but practitioners often use these terms interchangeably. People invest in pooled investment vehicles to benefit from the investment management services of their managers and from diversification opportunities that are not readily available to them on an individual basis. So, quick practice question. A friend has asked you to explain the difference between open-ended and closed-end funds. Which of the following will you most likely include in your explanation? A. Closed-end funds are unavailable to new investors. B. When investors sell the shares of an open-end fund, they can receive a discount or a premium of the fund's net asset value. Or C. When selling shares, investors in an open-ended fund sell the shares back to the fund, whereas investors in a closed-end fund sell the shares to others in the secondary market. Okay, this question has some nice little factoids with regards to the differences between open-end and closed-end funds. So C is correct. When investors want to sell their shares, investors of an open-ended fund sell the shares back to the fund, whereas investors of a closed-end fund sell the shares to others in the secondary market. Okay? Closed-end funds are available to new investors, but they must purchase shares in the fund in the secondary market. And because they're in the secondary market, the shares of a closed-end fund can trade at a premium or a discount to the net asset value. Now we're moving on to currencies. Currencies are monies issued by national monetary authorities. Approximately 175 currencies are currently in use throughout the world. Some of these currencies are regarded as reserve currencies. Reserve currencies are currencies that national central banks and other monetary authorities hold in significant quantities. The primary reserve currencies are the US dollar and the euro. Secondary reserve currencies include the British pound, the Japanese yen, and the Swiss franc. Currencies trade in foreign exchange markets. In spot currency transactions, one currency is immediately or almost immediately exchanged for another. The rate of exchange is called the spot exchange rate. Now we'll look at contracts. A contract is an agreement among traders to do something in the future. Contracts include forwards, futures, swaps, options, and insurance contracts. The values of most contracts depends on the value of an underlying asset. The underlying asset may be a commodity, a security, an index representing the values of other instruments, a currency pair or basket, or other contracts. Contracts provide for some physical or cash settlement in the future. In a physically settled contract, settlement occurs when the parties to the contract physically exchange some item, such as tomatoes, pork bellies, or gold bars. Physical settlement also includes the delivery of such financial instruments as bonds, equities, or futures contracts, even though the delivery is electronic. In contrast, cash-settled contracts settle through cash payments. The amount of the payment depends on formulas specified in the contracts. Now I'm just taking a quick screenshot of the ebook in this section, and the example is contracts for difference. And so I just wanted to do this as a quick example to show you that it's very important to go back through the readings, all the readings, and look at all the blue boxes. We don't do that in all the LOSs, obviously, but from time to time I like to choose some, and this is an interesting one. So contracts for difference. Contracts for difference allow people to speculate on price changes for an underlying asset such as common stock or an index. Dealers generally sell CFDs to their clients. When the clients sell the CFDs back to the dealer, they receive any appreciation in the underlying asset price between the time of the purchase and the sale, open and close of the contract. So if the underlying asset price drops over the interval, the client pays the dealers the difference. So our contracts for difference, derivative contracts, are contracts for difference based on copper prices, cash settled or physically settled. So you can see it's not a multiple choice question, but fantastic information there that you could see could be easily transformed into an exam question. So contracts for difference are derivative contracts because their values are derived from changes in the prices of the underlying asset. And solution for number 2, all contracts for differences are cash settled regardless of the underlying asset on which they are based because they settle in cash and not in the underlying asset. Futures can settle with the real asset, although they're usually closed out before settlement. So that's a key point. Contract for differences are always cash settled. You could see that could be a multiple choice question exactly. Continuing with contracts, we'll now look at forward contracts. And don't worry, there's lots on forward contracts coming up later when we look at the derivatives, and especially in CFA level 2. So this is just really quick introductions, So a forward contract is an agreement to trade the underlying asset in the future at a price agreed upon today. That's the key sentence. For example, a contract for the sale of wheat after the harvest is a forward contract. So people often use forward contracts to reduce risk. Before planting wheat, farmers like to know the price at which they will sell their crop. Similarly, before committing to sell flour to bakers in the future, millers like to know the prices that they will pay for the wheat. So the farmer and the miller both reduce their operating risks by agreeing to trade wheat forward. Continuing with contracts, we'll now look at future contracts. And again, this is just a very quick introduction. We're going to see a lot more on forwards and futures in other LOSs. Nevertheless, a futures contract is a standardized forward contract. So a futures contract is a standardized forward contract for which a clearinghouse guarantees the performance of all traders, which is important. With a forward, there's counterparty risk. With a future, there's not, because a clearinghouse guarantees the performance, okay? The buyers of futures contract is the side that will take physical delivery or its cash equivalent. So again, with futures, they can take physical delivery. The seller of a futures contract is the side that is liable for the delivery or its cash equivalent. A clearinghouse is an organization that ensures that no trader is harmed if another trader fails to honor the contract. In effect, the clearinghouse acts as the buyer for every seller and as the seller for every buyer. Buyers and sellers, therefore, can trade futures without worrying whether their counterparties are creditworthy. Because futures contracts are standardized, a buyer can eliminate his obligation to buy by selling his contract to anyone. A seller can similarly eliminate her obligation to deliver by buying a contract from anyone. In either case, the clearinghouse will release the trader from all future obligations if his or her long and short positions exactly offset each other. Continuing with contracts, now we'll look at swap contracts. A swap contract is an agreement to exchange payments of periodic cash flows that depend on future asset prices or interest rates. For example, in a typical interest rate swap, at periodic intervals, one party makes fixed cash payments to the counterparty in exchange for variable cash payments from the counterparty. The variable payments are based on a pre-specified variable interest rate, such as the London Interbank Offered Rate, which is LIBOR. This swap effectively exchanges fixed interest payments for variable interest payments. Because the variable rate is set in the future, the cash flows for this contract are uncertain when the parties enter the contract. Investment managers often enter interest rate swaps when they own a fixed long-term income stream that they want to convert to a cash flow that varies with current short-term interest rates or vice versa. The conversion may allow them to substantially reduce the total interest rate risk to which they are exposed. Hedgers often use swap contracts to manage risks. In a commodity swap, one party typically makes fixed payments in exchange for payments that depend on the future price of a commodity such as oil. In a currency swap, the parties exchange payments denominated in different currencies. Again, we're going to see more on swaps later on, and we see a lot in level 2. This is just an introduction. The payments may be fixed or they may vary depending on future interest rates in the two countries. In an equity swap, the parties exchange fixed cash payments for payments that depend on the returns to a stock or a stock index. Carrying on with the contracts, we'll now look at option contracts. An option contract allows the holder, the purchaser of the option, to buy or sell, depending on the type of option, an underlying instrument at a specified price at or before a specified date in the future. So an option is a right, not an obligation to buy or sell, okay? Those that do buy or sell are said to exercise their contracts. An option to buy is a call option, and the option to sell is a put option. The specified price is called the strike price or the exercise price, okay? If the holders can exercise their contracts only when they mature, they are European-style contracts. If they can exercise the contracts earlier, they are American-style contracts. Many exchanges list standardized option contracts on individual stocks, stock indices, future contracts, currencies, swaps, and precious metals. Institutions also may trade many customized option contracts with dealers in the over-the-counter derivative market. Finishing up contracts now by looking at other contracts. Insurance contracts pay their beneficiaries a cash benefit if some event occurs. Life, liability, and automobile insurance are examples of insurance contracts sold to retail clients. People generally use insurance contracts to compensate for losses they will experience if bad things happen unexpectedly. Insurance contracts allow them to hedge risks that they face. Credit default swaps, CDS, are insurance contracts that promised payment of principal in the event that a company defaults on its bonds. We'll see more on CDS in the LOS for fixed income later on. Again, this is just an introduction. Bondholders use credit default swaps to convert risky bonds into more secure investments. Other creditors of the company may also buy them to hedge against the risk that they will not be paid if the company goes bankrupt. Now we're moving into a quick introduction on commodities. Commodities include precious metals, energy products, industrial metals, agricultural products, and carbon credits. Spot commodity markets trade commodities for immediate delivery, whereas the forward and future markets trade commodities for future delivery. Managers seeking positions in commodities can acquire them directly by trading in the spot markets or indirectly by trading forward and future contracts. The producers and processors of industrial metals and agricultural products are the primary users of the spot commodity markets because they generally are best able to take and make delivery and to store physical products. They undertake these activities in the normal course of operating their businesses. Their ability to handle physical products and the information that they gather operating businesses also gives them substantial advantages as information-motivated traders in these markets. Many producers employ financial analysts to help them analyze commodity market conditions so that they can best manage their inventories, to hedge their operational risks, and to speculate on future price changes. So we're down to the last slide for this LOS, which is just an introduction to assets and contracts. So finally, we're going to look at real assets. Real assets include such tangible properties as real estate, airplanes, machinery, or lumber stands. These assets normally are held by operating companies, such as real estate developers, airline leasing companies, manufacturers, or loggers. Many institutional investment managers, however, have been adding real assets to their portfolios as direct investments, involving direct ownership of the real assets, and indirect investments involving indirect ownership, for example, purchase of securities of companies that invest in real assets or real estate investment trusts. Investments in real assets are attractive to them because of the income and tax benefits that they often generate, and because changes in their values may have a low correlation with other investments that the manager hold. Direct investments in real assets generally require substantial management to ensure that the assets are maintained and used efficiently. Investment managers investing in such assets must either hire personnel to manage them or hire outside management companies. Either way, management of real assets is quite costly. And that's the last slide for this LOS. Thank you.